Hello everyone, this is Akshara Menon from PMS Bazaar. A warm welcome for today's webinar. In today's session on the investment frameworks, a practitioner's guide, a topic that sits at everyone's heart for the consistent investing success, yet often overlooked. In India, we now have over 12 crore equity investors. The number has grown rapidly from 1.6 crore in 2013-14. Despite this growth, many investors still struggle to generate consistent returns, not because the lack of opportunities, but the lack of structure. So, in this webinar, we're going to go beyond textbook theories to understand how real investment frameworks are built. We will discuss how professional investors combine business quality, market cycles, valuation discipline, and risk management into a repeatable decisions making process. We will also walk you through the practitioner's journey from idea to position, how frameworks guide not just to buy, but how to allocate, how to add, trim, and exit. Importantly, we will explore how structured approach helps to separate the signal from the noise in the market. It can be narratives, it can be hype. One should know how to know the difference between it. Finally, we will look into how strong frameworks can adapt across market cycles. By the end of today's session, we will leave you with a practical insight to build a disciplined investment approach that supports a long term wealth creation. So let's get it started. It's my pleasure to introduce our speaker for the day, Mr. Sumit Agrawal, Senior Vice President, Nuvama Asset Management. Sumit is a CFA, charter holder, company secretary, and holds an MBA from Symbiosis Pune. Sumit brings over 20 years of experience in investment management with 15 plus years in fund management focused on equity investing and portfolio management. He had his key roles at Bandhan Mutual Fund, Mirae Asset Mutual Fund. Now he is currently at Nuvama. He manages long only equity strategies and serves as a fund manager for Nuvama Flexi Cap Equity Fund. Earlier, he contributed to institutional equities research at INAM and led by the team at JP Morgan Investment Banking. So, beyond this, I would like to give the podium to Mr. Sumit to take it forward. Before that, for all of you, put your questions on the comment box below, which will be taken post his PPT, and not to ask any stock specific questions. So, over to you, sir.
Thanks, Akshara, and thanks, PMS Bazaar team, for giving us the opportunity to interact with investors and partners. And very timely, I think the topic of the presentation that we have chosen is about investment frameworks and practitioners' guide. It's more relevant in the current market context because probably no matter if you are a successful investor or a novice, the current correction is probably forcing all of us to think about as to what actual investing is, what should we do. So in a nutshell, just this entire talk will not be about stocks and what to buy, what not to buy, but about the investment process one should follow. It has a summarization of, let's say, my learnings of last 2 decades. I'm still improving, I'm still learning because markets give you opportunity every day. So hopefully you will benefit from some of our experience. So please lighten up. Don't feel slightly stressed about the market context. I think all of us go through these cycles, and hopefully there is something to learn and act on at the end of this session. So essentially, my talk is going to be about frameworks, and framework is something which we apply across market cycle, not necessarily only in bull markets or bear markets, but these are, I would say, some guardrails or some fundamental philosophy, and it might be unique to each individual and might differ maybe from a person to person, but more or less, if you look at the history of all the successful investors in the world, more or less most of them have aligned with, I would say, 70-80% of this thought process. And which is where I'll take you through. And one of the most defining underlying philosophy that would define my investment framework is the line which you read at the bottom. which says that simplicity is often underrated, and yet it is the most powerful trait. So essentially, all your frameworks, has to be, at the end of the day, has to be very simple. Because if you make it too complex and too difficult to understand, probably you'll get lost in the process, and it might not be very powerful in that context, because a lot of variables might move. So just to begin with, if you look at the typical investor's paradox, now it can be a long-term investor or a short-term trader, or maybe professionals or practitioners like us. Maybe let's say we let's have a look. Where do we spend our time on? So as most investors, I recollect my early days as an analyst. There used to be a lot of time being devoted on analyzing stocks and sectors, probably weeks and months and days, wherein you would read about a particular company in detail, do management meeting, channel checks, read about competitors, speak to fellow investors, or maybe some of the analysts on the street, some of the existing investors, and a lot of time been devoted on those ideas about analyzing stocks. And once you probably make a view that, okay, these are the set of stocks that I need to study further, and those are sectors where I need to devote more time on. You devote some time on modeling, making some financial projections based on the past track records, based on management commentary, or some of the economic variables. And essentially a lot of time, I would say very important groundwork that you spend your time on. And let us assume after devoting all this time, you arrive with, let's say, 10 stocks that you want to buy in your portfolio. Now comes the more difficult question, which is, if I ask you, like, okay, these are 10 stocks, but how much to buy? Would you want to add more to those positions after you have bought? Or, when to exit if you have bought and made money, or maybe not made money? Do you have any systems for that? Probably not, because as the way we have developed ourselves or grown in life, probably more time goes in analyzing stocks and sectors, but lesser time on developing frameworks and systems for it. So the idea is, if you have a defined system for a simple repeatable system which you can deploy all the time across market cycles, which kind of guides you fairly as to how much to buy, when to add more and exit, I think it will be helpful. Probably, a very novice way of investing is maybe just do an equal weight of 10 stocks, or 10% each in the portfolio, and divide your money. But it looks very simple, but do you think it's a very rational choice? I probably think no, it is not a very rational choice. There has to be some science behind how much to allocate in the portfolio. I remember my early years wherein I was given a fund to manage, which was a focus fund, where only 30 stocks was designed to be part of the portfolio. And in a hall full of investors, I used to ask, okay, how many of you have actually identified multi-baggers? And there used to be a very large number of people maybe who will raise their hand and say, okay, I identified this stock which went up 3x, 5x, 2x. And then I asked the second question, how many of you how much of that stock has helped you guys in making your wealth? Probably, not a lot of investors would raise their hand. And the answer was that, sir, we identified this stock. We did good work. Stock actually more than tripled or went up 5 times, but we bought very little. Now, this is where the real problem is. So, intelligent investing is also about allocating as well as selection. And how do you do that? So let me just take a step backward. The framework which I have been following all these years, and I'm a firm believer, I think this works across cycles, is about, and it guides you in times like this, is about the BMV framework, which is, business management and valuation. Now, if you come across any company or sector, these are the three fundamental questions that I ask, where you analyze the business per se. The second important pillar is the guys who are running the business, and third is probably the price at which you're buying or entering as an investment. Now, some of you might say, okay, we have heard this a lot, probably a very plain and simple thing. Maybe many successful fund managers follow that. I think that itself is the answer to itself, that It is a framework which is very simple and yet has proven itself many a times in the past. And what matters more to me, which I have understood over the years of experience, is it's not only these three pillars themselves, but how do they interact with themselves. For example, there might be a good business, but probably average management and maybe, let's say, very high valuation. And so, what will you do? Will you buy or will you not buy? Similarly, there might be a situation wherein you will have a very attractive valuation, very good management, but probably a feeble business. So interaction between these three pillars actually gives you a fair bit of idea to generate alpha, and that is what we as practitioners do. I'll just take a moment to explain the first pillar, which is the business part itself of the BMB framework. Now, what I mean by business is that the business that the company is doing or where you are investing it has to be a scalable business which can grow, let's say, 5x, 10x from the current base. It has to be a business which has a large size of opportunity because you're investing not for one day or 1 week, but for multi years. And secondly, is that business generating a return over a cycle which is higher than the cost of capital? So let's say in loose terms, you can define it as an ROC or return on capital employed or return on invested capital. But generally, in broad sense, the return that the business is generating should be higher than your fixed income cost or your cost of capital, probably if you add a little bit of equity risk to also it. So there is no point owning a business which is growing very fast, which can become very big, but in a sense, it's not even generating, let's say, a fixed income return of your equity. For example, you invested 100 rupees and you're just getting, let's say, an 8% as an ROE. But the business is growing at 50%, 60%, probably not as rewarding business that I would probably not filter through my framework. Now, so this gives you a fair bit of idea about the business. Second is about management. So the guys who are actually running the business, what is the quality of that management team? Some of them might be promoter-led, some of them might be professional-led. And the best way to judge a management is how do they behave in difficult times? Because in good times, more or less every business does well. But in difficult times is when the actual management skill of good quality teams who are running the business actually comes. So prime examples are, let's say, period like COVID, wherein a lot of the business models got disrupted overnight. There were a very quite a few successful management teams who actually changed the business, evolved into a few better things to come out of that thing. And those are the tough times wherein the quality of management actually arises. There are a few other yardsticks like let's say how do they behave with minority, corporate governance, dividend payouts, capital allocation, which you might hear a lot. I think those are also some of the measurable aspects on which the quality of the management can be checked. Last but not the least, valuation again is the very core pillar of this framework. Because you might have a fantastic business run by a very good quality management, but there's no point buying it very expensive because it might look like a very good asset on the portfolio, but that asset would not generate good returns. So essentially, valuation becomes very important. Again, I want to highlight one point that please do not confuse valuation with a single point in time estimate. For example, markets looks expensive at, let's say, 20 times 1 year forward, or looks very cheap at 15 times 1 year forward. Because in practice, you don't buy business for 1 year, right? This is just a yardstick about measuring the broad value of the market context. If you have a company which is growing, let's say 30% for the next 5 years, and there is another company which is growing, let's say 10% for the next 5 years, and both the companies are trading at let's say 30 times, obviously company which is growing at a faster pace for the next 5 years is relatively cheaper because the rate of growth rate is higher. So essentially, do not earmark to any particular time frame, or don't use it as a single point in time, but have a full cycle view on valuations. Now, let me take you to the second step, which is about when you filter companies on the business management valuation framework, how do you define and when do you actually decide how to make money? So a lot of ideas, let's say, which I work on, and you get the ideas at the investment table, then you evaluate them on these four quadrants. Now, this is a very structured way of thinking. On the left hand side, let's say on one axis, you have businesses where you rate them on rate of growth. So how fast are they growing, or maybe not fast, but what is the trajectory of their growth? So it can vary from low growth businesses to high growth businesses. And on the right hand side, or which is, let's say, other axis, you will have things like the quality of moat. Now, moat might be a very difficult word, or maybe a very difficult word to understand, but you can measure it. I broadly measure it with things like, let's say, ROC, or return on invested capital, or return on capital employed. So this gives me a very good sense as to whether the business is growing faster than the market, and whether the business is also generating an ROC which is higher than the cost of capital. So if you are growing very fast, generating more return on your capital employed, that essentially is very value accretive. So this gives you the leftmost top quadrant, which is a quadrant of stars. Like, these are the businesses which all of us would want to own, growing very fast, giving you very good ROC and ROE metrics. The only problem with this quadrant is that most of the time is well discovered, and it's richly priced, so perhaps may not fit into your valuation parameters. But the way to make money here is identify it beforehand, before a larger audience actually recognize it, and keep monitoring that moat and rate of growth. So I'll give you some examples here. For example, if you see, let's say, the largest paint company of the country, what was it in 2005? Perhaps growing very fast, ability to take pricing power, very strong moat, and still trading really reasonable. Or maybe the case was with the largest private sector bank of the country, let's say in 2005 or 2010, still growing at 30%, and very strong moat, very high ROAs, probably not that expensive. So you have to be ahead of time here. Then comes the second quadrant, wherein the rate of growth is very high, but the companies are not generating good ROC or good ROEs. So essentially, in my term, this would be slightly weaker mode, wherein as long as growth is there, probably market might reward them for some time. But essentially, if the business is not generating a reasonably good ROC on the capital employed, then the valuation might not sustain. And mind you, I'm not saying maybe, let's say, for 1 year or 2 year, but give it a cycle. For example, the new age platform companies which have been there in the country today, probably was not making money about 3 5 years ago, but the rate of growth was very high. But if you see today, most of them are actually making money and generating good return on capital employed, or at least the trajectory is very good, and growth is continuing. So you have to evaluate businesses from that aspect. Then there is a quadrant called low growth and strong moat. Now, I would say, these are very stable cash cow companies, but which will generate very high dividend payouts or very high ROC, but the rate of growth is very low, or probably at best in line with the market growth. So these are your cash cows. These stocks generally don't fall. This gives an anchor to the portfolio, but this will not lead to a lot of PE expansion. So do not expect a lot of upside to these kind of stocks. Then the fourth quadrant, which is about businesses very weak moat and even growing lesser than the market. Essentially, these are generally available at very cheap valuations. And I remember saying that if something is trading cheap, probably it is because of a reason, and we should try to identify what is that reason. Most of the time, these are value traps. You should generally avoid these companies. However, if you are trying to invest in one or two or three names in such ideas, try to be very bottom up, and keep a very sharp eye as to whether the company can change the quadrant. So I'll give you an example. For example, if something which is low growth and weak ROC, if it is transitioning to a high growth and weak ROC, or a high growth and high ROC, that is where the maximum P re-rating would happen. I would give an example of, let's say, there was a time when the fuel was not deregulated in India, and a lot of OMCs were having a lot of working capital which was stuck in the receivables from the government. But then there was deregulation, and all of these cash companies, working capital cycle started beginning to compress, and you saw massive re-rating because working capital got shrunk, and growth was reasonable. and the quadrant got changed. A lot of these OMCs actually transitions to maybe from a weaker mode to probably a healthier mode, and you saw PE expansion. So this is one of the examples of that. So essentially, this is the quadrant which helps me decide as to what companies I will say pass and what companies will form part of the portfolio. Now, again, a very important aspect: how much to own. Now, this becomes really important because there's no point identifying a great idea but owning very little of it, or maybe identifying an average idea but allocating very large amount to it, maybe because it's very popular, or your friend have it. So this is a matrix which I follow. So this has three parameters called attractive, fair, and expensive on valuation. And on business, something which is very strong, maybe average business, and maybe weak business. So something which is very clear is, something which is very strong as a business, and I've given you the BME framework and the four quadrant. Something which is very strong forms a core buy, and if valuations are attractive, definitely it's a good sizable position in the portfolio. However, as I said, most of the time these stocks might be very expensive if you are in that zone of the market, and valuations are only fair. Still, it's a buy. Maybe add on dips. Do not allocate very large at one go. At the same time, if it is still a very strong business but has become very expensive, which is where the valuation angle of the BMV framework kicks in, probably for the price that it is trading at or it is evaluated in the market, it becomes a hold. Maybe at higher expensive valuations, you would want to reduce exposure to such stocks. There are multiple examples of this in the current market, like the darling retailers of the country. The largest one of them may be in fashion or grocery. You've seen how expensive valuations have given to mediocre returns. Still, some of the stocks are 60 times, 70 times, but still a very strong business to own. So probably trim on rallies or hold. Similarly, goes with the other metrics like average. For example, if it's an average business and very attractive valuation, probably have a medium-sized kind of a position. However, if it's an expensive zone and a very average business, not recommended to be part of the portfolio. And the other one on the right hand side, which is weak businesses, generally, even if it's trading at expensive, clear avoid. Even if it's trading at fair value, clear avoid, because frankly the quality of the business is not that great. However, if the valuations of weaker businesses are very attractive, and if there are any catalysts which can lead to the company actually changing the quadrant, moving from a low growth, low ROC to high growth, high ROC, or high growth, low ROC, or maybe any of the other top two quadrant, probably here is when you can have a large re-rating. So very bottom up approach needed here. Now the very important question: how much to buy? I told you the broad way, what is core, what is moderate, and what is strong. But in terms of the positioning sizing, I think beyond 25, 30, 35 stocks, the benefits of diversification starts deteriorating. There's enough literature on it. So the way I think about investing and what is my model evolved is probably something, you have a very strong business, very good, excellent quality of management. It forms part of the core holding. Let's say for me, it works to be between 5 to 8% of the portfolio. It might differ from person to person, investor to investor, but you have to be comfortable what you are comfortable with. Maybe something which is very weak business, weak management does not passes my filter, so it's a very hard pass. Similarly goes with the average businesses. Again, very little position. And let's say sometimes you get an average business but with excellent management. Now, this is a good part about reposing confidence in good people, because good people have the ability to turn around the businesses into greater businesses, and we've seen numerous examples in the past. So the way I think is have some moderate exposure over there and align with the developments that keeps on happening with the stock and with the businesses as you observe them. Then there is something in between wherein you have a good business and strong management, and a good business and average, good management but average business. Again, the same theory applies. So one thing which is very common here is that there's no place for mediocrity, because essentially you're not buying 20, 30 basis points, you're buying like at least 2-3%. So no point in buying weaker businesses or management team which are not that great. So this is how the size reflects your conviction, because if you have high conviction, have higher weights, have higher active share, and as your thesis proves out, you start building positions to that as well. So in a way, from idea to position, I normally keep it as a 5-step process. So first step is obviously idea generation and filtering, and ideas can come from anywhere. It's no rocket science that ideas has to be come from very learned community of analysts and investors or fund managers. It can come from everyday life. It can come from research reports, newspaper reports. It can come from your observing scuttlebutt approach. It can come from the things that you look around you. You know that things are growing. This is how things are changing. So this is ideas can come from anywhere. It's not that it has to come from the most prestigious fund house or the most prestigious fund manager. I've seen best of the ideas coming from very normal people as well. However, all those ideas needs to be filtered. The way I filter is through the BMV criteria, which I've explained right now. Does it pass all the 3 pillars? Once it passes the BMV framework, the major work starts about deep dive in conviction, which is where all your financial analysis, management analysis, your entire research work goes into it, and do a perception variance analysis. What is the market perceive of this business or this stock? What is your assessment? Where is the consensus wrong or consensus right? And depending on that conviction and the price value gap, you try and allocate capital in terms of the position size into the portfolio. Now, how do you do that intelligently? I have already explained the framework a couple of slides earlier. Use that selection metrics, something where your conviction level is very high, definitely deserves a higher weight in the portfolio. Now there is no rocket science into it, but my point is, if you're not confident about an idea, no point having larger weight in the portfolio. Similarly, if you're very confident about an idea and you don't have enough weight in the portfolio, you will not do justice to your conviction. So at the end of the day, you have to be comfortable with your portfolio you're managing. So therefore, position sizing becomes very small. And in my view, having 20, 30 basis points of position with a very long tail probably will not give you that result unless you're managing like very, very large sums of money. So be very mindful of the position sizing. This eventually leads to portfolio construction. So now this again is a very, very, I would say, very depth, it's a very important science. You can make mistakes, but do not make mistakes which you cannot survive for. So for example, you try and design portfolio for alpha, but do not have a lot of correlated assets into it. For example, you cannot have single largest exposure to a particular factor, let's say a particular industry or a particular kind of theme, because that becomes a very thematic kind of portfolio, which might do very well when themes do well, but can do very bad when themes go out of control. And if you would have seen in the last 2-3 years, there were a lot of thematic funds which came in. Generally, my observation is a lot of these themes come when the themes have already played out. Maybe some of these themes are still longer term themes, but one has to be very mindful while constructing the portfolio. It has to be well diversified across sectors and style, and as well as stocks, which I already talked about. The last but not the least is the most important thing about ongoing management. For example, once you've constructed the portfolio, when do you add on to the position? When do you trim your position? When do you exit your stocks? Now, this is something which is an ongoing thing in terms of the way I have evolved in my investing journey is whenever there are inflection points in the journey of the stock or the business, I try and add on to those positive inflection points. Let's say a company might be working very hard for 3-4 years to achieve that scale. And once that scale has achieved, the incremental revenue growth will give you very high margins or very high incremental ROIC. Now, that is actually an inflection point in the journey of the business. Please add on to your positions during that time. Don't think that valuations are full, probably because companies are going to change orbit in that zone. Similarly, when valuations become very expensive, maybe stocks trading 40-50% above your fair value zone, which you have assessed, or maybe a lot of consensus, lot of narrative driven rallies, probably time to trim some of those stocks at that point in time and Last but not the least, if the investment thesis itself breaks down due to some micro factors or macro factors, don't be in love with your stocks. Just exit those stocks. There are 100 other ideas in the market. Try and find a few of them, but there's no point, being very close to your stock when the thesis itself has broken down. So essentially, what you're doing is you're separating noise and signal. Now, what I call noise is, we live in digital world today. It's very easy to get access to what the management is saying or what the number of analysts are saying. We are in the world of social media, the world of Twitter and Reddits and whatnot. Similarly, in terms of the disclosure levels, I think there are various ways things are getting disclosed in the market. Various AI tools available to discuss, compress, analyze those information in seconds and minutes, maybe much faster than what humans can do. Uh, but in my sense, in my view, all of these things probably kind of are noise. What you have to identify is signal. For example, every incremental narrative that you are hearing, is it adding on to the sustainable mode of that business? Is that adding on to the incremental ROC that the business is generating? Or it is actually deteriorating it? For example, if there is a company which announces a diversification into a new business line, the short term it would be like, maybe stocks goes up because people are excited, market is in a bull zone. But the question you have to ask is that incremental diversification would add on to the sustainable mode of that business? Would it increase the incremental ROIC of that business? Is it a fair capital allocation? And that is when you evaluate, because noise happens very often. You might get five news flow on the same stock maybe in a matter of 1 hour, and stock price might move anywhere. So it's beyond our control. However, focus on signals. And last but not the least, please track insider actions as well, because some of the businesses which are run by insiders, or I would say promoters themselves, their actions also guide you quite a lot as to what they think about the market. Some of the other ways is to track maybe dividends or buybacks in companies which are institutionally owned, probably. So this is how you separate signal from the noise. And at the end of the day, just imagine one thing. Just ask one question: if the market is closed for 5 years, there's no trading on those stocks for the next 5 years, would you still own that business? And believe you me, if the business has passed through all the BMB framework and the assessment that you're talking about, then you would not be worried if the market is closed for a few years or few time, and you'll not be worried about the short-term movements of the thing, because businesses themselves are growing quite good, and sooner or later, market is going to acknowledge that. So this is how I summarize my framework, the way it works across market cycles. Because see, framework has to be adaptable to market cycles. You cannot have a framework which works only in bull market or works very only in bear market. The way I've evolved with the framework is, in bull markets, amongst the three parameters that I have is BMV, which is business management and valuation. I think valuation discipline is something which saves you quite a lot of things to go wrong. For example, let's say coming out of COVID, market was in a very bull zone, and a lot of stocks were trading at a very high valuations. And sooner or later, probably as things normalized, probably valuations corrected, stocks also corrected. So especially in bull market, I pay let's say 60% weight to valuations, about 30-35 to business, and maybe 5 to 10% to management, because at that point in time everybody will talk bullish about their own business. Market scenario is very bullish, so everybody is very naive to believe whatever is said in the market. So stick to your valuation discipline, do not overpay. Now the 60-30-10 can be 50-40-10 for someone else, and it should be completely okay, whatever goes with your own psychology, but pay a larger heed to valuation discipline. In normal times where markets are consolidating, probably not very expensive, not very cheap, probably give an equal weight to most of these three frameworks. And last but not the least, especially in bear markets, this is where a lot of people get stuck in value trap, because they pay a lot of attention to valuations. This stock was available at 15p, now it is available at 10p, it's become very cheap, so let me buy it. In my view, that is probably not the right approach. And in this zone, focus more on the quality of business you're going to own, because Normally, once the bear market will get over, the weaker businesses would go out of the market and stronger business will actually come out very successfully. So these are golden times to buy stronger businesses at cheaper valuation. So pay a very large weight to business, very large weight to the people who are running it, and maybe slightly or a last bit would be valuation, because generally also most things would be available cheap. So the beauty of this framework is that framework is staying constant, but the application is actually evolving with the phase of the market, and there is no style drift. Probably one of the common framework mistakes that we as practitioners or maybe most of the investors have done in the past as well, generally, creating very complex models or very complex kind of frameworks. You have like moving averages or some matrix on scoring framework or some other 50 variable models. See, all that will only confuse beyond a point, because I don't think the market price is looking whether your 48th variable is right and 49th variable is also right and 50th variable is also right or not. I think broadly market looks at about 3 to 5 things. Your quality of business you're owning, is it growing faster than the market or the competitor? Probably the return on your capital employed that that business is generating, and are there any governance issues or some other aspects which needs to be so generally about 3 to 5 key variables. Second common mistake is most of the time we are backward looking. So see, one argument is this stock used to trade at 50 times P in the past. Currently, because of the correction, it is trading at 35 times, and it will mean revert to 50 times. Therefore, it's a buy. Similarly, the stock used to trade very cheap earlier. Now it is slightly higher, so it will mean revert to the previous PE. Again, these are wrong metrics to look at. Look at whether growth trajectory of the stock is different, whether the ROIC or the incremental return on capital employed is different. If the incremental ROIC on a business which is growing faster is different from what it was in the past, let me tell you, the multiples currently will be far expensive than it was in the past, and it will not mean revert. So again, focus on business and not on the stock historical multiples. Third is this fascination about false precision. I often meet investors and some of the friends who say, "What is the Nifty EPS for FY21? Maybe 1 year forward or 2 year forward?" And we'll say it's 1084 or maybe 1123. These are the target prices 423 rupees. See, life doesn't work in very exact valuations or very exact precisions. You have to work with ranges. Broadly, where is the fair value zone? Is it like 20% lower, 30% lower, or a 20% higher, or a 50% higher? 5-10% here, then there will not make a lot of difference. You have to be right with the trajectory and not with the actual, measurement of the trajectory. So work in ranges, work in scenarios. It will make your life simple. Nobody knows how it will be tomorrow, but have a framework of scenarios and ranges. Fourth is drifting from the framework. For example, if you're switching your styles, so for example, in bull market, you were a growth investor, but in bear market, you have become a value investor. And somewhere in the middle, you have gone to quality, and with the advent of all the quant funds, now you have become a momentum investor. See, all this thing will not lead you anywhere, and your performance will be all over the places. So stick to the style. I'm not saying if you are a value investor, you cannot transition into a growth investor. You can. With time, you will evolve. With time, your philosophy will evolve. The way I have also evolved, and maybe many successful investors will evolve themselves. So keep learning and stick to what suits your temperament. You cannot have a temperament which is not of your own, and you can have it, and you will not have an investing style which is your own. So both of them has to match. And last but not the least, I always pay a lot of emphasis on position sizing. You have to make sure that the size of your mistakes should not exceed your size of your size of your wins. Your errors have to be small, because errors will happen. uh, Even the most successful people have a lot of errors, and the only way of doing better is reducing the size of errors. So what a robust framework looks like is simple enough to be explained in 4 to 5 minutes to yourself. It should survive a full market cycle, includes position and sizing rules, have a clear exit criteria, and last but not the least, it should align with your psychology. If your framework is not aligning with your psychology, it will not work, however robust the framework is. So let's say if this thing is working for me, but it is still not aligning with maybe some of you, you should not follow this, because that does not align with your psychology. Probably follow what aligns with your psychology, because in times like this, which is today, what is saving you will be your frameworks. Otherwise, you will keep on drifting from your investment thesis. So essentially, to summarize, key takeaways from my talk would be, a true framework is not just stock selection; it's a decision system. It works because it's very easy and very simple to apply consistently over time, over cycles. It focuses on driving long-term value, focuses on business and not stock prices. It adapts to cycle, not necessarily working only in bull market or bear market, but it adapts to cycle. I have given you an example how. And have humility to own your mistakes. Mistakes do happen, and make sure that even if mistakes happen, the size of your win, the stuff that you're doing which is done good for you, it should always exceed the size of your mistakes and not vice versa, because one big mistake, one big position size can wipe off the entire capital, and no matter the your rest of the work is good, but one bad position sizing can actually bring you down or bring you back for by 2 3 years. So essentially, a good framework makes this possible through a process and not perfection. So do not aim for perfection, work in probabilities, and try to have a framework. I think this is what, in a nutshell, is my initial talk on this, Akshara.
Yes, it was, sir. It was actually. It was a very good PPT. It had everything in it. And also, it was more like, investor friendly. It was like, didn't have any financial heavy words. Even a layman investor will be able to understand it. Even you took about, business management valuation. I would say this the whole PPT was like, through investors' lens, how to see the market. So, with that perspective, let me take the first question of it. Actually, regarding market part, Indian equities have delivered strong return over the past few years, but toward forward returns, they might look a bit uncertain with the current market situations and all. So, from the investor's lens, what should be the ideal or realistic expectation they should have on the Indian market? Correct.
See, my view is that essentially market, if you just theoretically see, market returns are construct of your earnings growth that the business is generating. Now, theoretically, it would be about, let's say, if you clearly say no extra efforts by the company, you have a population growth, you have an inflation, let's say 1.5 2% population growth, you have a inflation of about maybe 4% 5%. That gives it your natural growth, and then there's a real volume growth which is happening. So if this is how the way to think about evaluating businesses. Now let us assume there is a business which is actually adding a business line.
Hmm.
The guy is actually selling product X, but incrementally also beginning to sell product Y, which is going to the same consumer. The second leg is the same consumer first was buying this, now he's buying more of this,
Hmm.
buying more from this company itself. So that adds another your levers to your growth. So essentially, see, index at index level, index is just an aggregation of, Nifty is aggregation of 50 stocks, likewise 200 stocks and other stocks. More or less, all of these are leading to a longer term earnings growth rate of, let's say, about 13 14%. This used to be very high about 3 4 years. If you ask me, this rate of growth used to be 17 18%, now tapered down to 13 14%. Broadly, that is what should be the fair value growth of the market estimates of the estimated return. Now, if you happen to invest at this earning growth at expensive zone, your realized return might be, let's say, 14% earning growth, your realized return might be 10% because you're
Hmm.
investing at an expensive zone. But if you are
Yeah.
investing at a slightly lower than fair value zone, earnings growth might be 14%, but your portfolio return can be 18%. And which is what all of us try to do, that buy companies which are trying to trade at a valuation zone which is lower than the fair value and growth is higher, and therefore deliver an alpha which is over than the overall market return. But in the
So,
longer term, earnings growth will follow your market growth. That is what I think.
So the alpha part, in the current market situation, you don't think that it's narrowed? We still have, that space or that momentum for alpha in this current market. Is that what you?
See, alpha is a direct correlation of. I follow a very structured approach of thinking. It's clearly about your active share, because when you're talking about alpha, it means how much extra are you earning, or how much extra you're not earning. So let's say if an index gives you 15% and you are 20, you are a plus 5% alpha.
Yeah.
You are 10, you are a minus 5% alpha. So essentially, if you are just copying the index or copying whatever your benchmark is, the degree of your copiness will not give you any alpha. So you have to be different, and which is what mathematically we call active share. So if you are running portfolios which are different, I would say an active share between 60 to 70% is a very reasonable active share to have. So for example, if I'm running a portfolio, I've historically run portfolio which have very high degree of active share because I do not believe in benchmark again, because otherwise there's no point of paying money to an active fund manager. You can straight away go and do index investing. So running a very high active share, a 70% active share probably will give you higher chances of a positive alpha subject to your stock picking goes right. If being
Okay.
different and choosing wrong stocks will give you on the put you on the other side of alpha. So I would say constructing a portfolio of 25, 30, 35 stocks is still a very good thing in India. You can easily do. There are large number of listed stocks available. And for someone who is bottom up oriented, generate a portfolio, construct a portfolio with good, reasonable active share, and you can still deliver alpha, even in a slightly lower market conditions.
Okay. I just want to take one question from the audience. I think that was one question that attracted the eyes from Umesh. He's like, how can we adapt this framework when we're allocating money to different fund managers?
See, first thing is you have to be comfortable. Like when I was, let's say, 10 years ago, probably I was analyzing the same stocks remain same, right? The same. You only get newer stocks, but the old stock stays there for years. Uh, Perhaps the way I was looking at a particular company has also evolved over a period of time. I know how this bank was behaving 20 years ago when it was growing at 30%. I know how they are behaving now when it is competition is very large, their scale is big up, how they are behaving now. So only way, probably from an advisor's perspective, is to know your fund managers well, know your fund houses well, read about them, read about the investing philosophy. How do they behave, not in good times, but in bad times? See, I always say, like I was talking about management quality, it's not about how funds do in good times. In good times, everybody will do well. 2023, 2024, and 2022, 2021, phenomenally, small caps were like rocking all the time, and
Yeah.
entire money was going, like what is happening to probably gold and silver right now. But only in tough times. It's not that I have not seen. Like 2017, I got a very good fund performance. 2018, I was a disaster. But what makes one good is that are the manager of the money humble enough to acknowledge their mistakes, and at bad times are they communicating well with the investors? See, investors know that money is being handled by good, experienced people, but what they need is assurity and just confirmation that they know what is happening. So, like the framework that I have always followed is that whenever with my investee companies, I don't know what is happening, stock prices are correcting, I try to engage with them and try to have a dialogue just to see communication. What is happening? Are you in sync with that? Are you not in sync with that? If you're not in sync with that, evaluate. But if you are in sync with that and it is only a matter of macros or entire broader market, probably just take a feedback and maybe it will pass on.
So basically, it's like, trust the fund and you trust the fund manager. So that's how you're going to be.
Absolutely.
So I'll take the next question from Kunal. Like, India's growth story is looking good, but the earning doesn't do well, then which factor can play well in this present scenario?
See, I always believe that when you talk about India growth story from a 5 year, 25-year view, everything looks good, right? Everybody say India is a good success story, or rate of growth will be very high, but essentially earnings growth have tapered down. We were growing at a 15 to 16%. Now we are 9, 11%. And still, if you talk about the next 20, 25 years, long-term picture still remains very good. So essentially, what you have to do is focus on individual stocks and businesses which are still growing faster than the market. A lot of new businesses has also evolved. Some of the smaller companies, like you cannot expect a company which is a turnover of 10,000 crore to grow at the same rate with a company which is a turnover of 1,000 crore. Smaller
Oh,
companies will always grow at a faster rate.
fast.
I would say, and one thing which has also happened is the inflation is also currently is quite collapsed. I would say in some of the reported numbers due to base effect or on. Therefore, your nominal earning growth also looks like 10-11%. So these things look very good from a macro perspective that India is growing at this, but you don't have to devote a lot of time over there. Leave it that for economists and newspapers and journalists. You as investors just focus on buying stocks, good companies growing 20-30%, available reasonably, and make a portfolio. It will work well.
Okay, I think that's a mantra. Can say it as a mantra to the investors now. So I'll take one more question from Srinivasan. What is your view on core? Say 60 or 70%, and satellite which is 20-25%, and symmetry bets at 5 to 10% max. Do you suggest this framework for medium or large size corpus?
See, basically, this core and satellite philosophy, it's a good approach of generating portfolios. In fact, I have also practiced it for a long time. What it does is, because see, market moves in cycles and
Hmm.
economy also moves in cycles. Sometimes you can predict the cycle well, but sometimes cycle. In fact, incrementally in the last 5 years, the size of the cycle is only shrinking. What used to happen in 3, 4, 5 years is now happening in 2 years, and things are rotating. So I would say have a there was a slide in my presentation which talks about position sizing and core holding. If it fits in your business and management metrics, have a core part, be part of the core portfolio, which is about 60-65%. I think is a good thing to have, but don't be very adamant about it, because normally I'll tell you where the mistakes happen. People keep 15% as satellite. That 15% does very well in a year like 2017, or let's say post COVID. That 15 become 25 and 30, and they let it ride. They don't do an auto rebalance, and then the market reset happens. The 30 immediately becomes 20. So essentially, whatever framework you're following, follow it consistently.
So basically, a change of framework may also lead to this underperformance of that particular portfolio.
Yeah.
So I think with that, you had given while doing the PPT, you had given a lot of scenarios. But if I had to take one scenario, like one random thing is if a stock declines by 30-40% from the but the original thesis or original framework remains intact. What would the first framework check that you would do that you would do whether you will to decide whether to add on or to hold or to exit? Just imagine the portfolio. I'm just giving an example. Like the portfolio, it can be stock. I don't want to name the stock. Like that fell by 30-40%. So in that framework, what is the one particular thing that you will look into?
Yeah, I think this is something which we grapple every day, and with the current scheme of things, I think it's everyone is grappling with it every day. So first thing is, again, look at the BMV framework. So first is the quality of business still intact? Answer is probably right. It's
Hmm.
still intact. Is the quality of management who are running the business still intact? Answer is right, because you're the same people, they are running the business. What has changed? Stock is corrected 30%. Why?
First.
Because there's some restrictions, you cannot export, or there's some tariff issue or something. So business is shut for 3 months.
Hmm.
So what has changed? Valuation, which was maybe fair or expensive, has become less expensive or less fair, more attractive. As practitioner, as a novice, I would say just go ahead and buy.
Okay.
As a
So you will
novice.
buy in that particular scenario.
As a
Okay.
novice. But if you remember the fifth point of my presentation, where you are ongoing monitoring things, see, because ultimately money is limited. You have 100 rupees of portfolio that you have to deploy. Valuation, if it corrects, I can deploy it right now and I might feel happy. Okay, I bought it cheaper, but tomorrow it will become more cheaper. What will you do?
Hmm.
So identify the catalyst if things are changing, and let it change. Like don't have a habit or an ambition to buy at 52-week low or at the lowest point price. Buy 10% expensive, but still have a layering to it. You can add some, wait for some time, see how it is playing out, deploy into some other idea also if you have something of that sort. Because a lot of other, ultimately you're constructing a portfolio and not a single stock, right?
Yeah.
But I would not suggest to go straight away, go ahead and buy just because stock is corrected 30-40%. You have to be practical, and you have to adapt yourself to your thesis also. If the thesis is intact, okay, I'll buy, but I'll allocate some and then wait for some more time. It's okay to miss maybe 10%. It's okay.
Hmm.
कहीं और से बन जाएगा, you can make it like.
Okay, like probably a follow-up question. At what point should an investor accept, that lower future returns at the, price of safety? At what is the point should an investor think about it?
See, essentially, what I have seen is that, especially in the Indian context, even the best run companies, some of the time runs to valuations which are like north of 70 times, 60 times. We've seen examples of great retailers, be it in jewelries or grocery or fashion retail, or maybe EMS is the latest darling of the market, which used to trade at those valuations. I think as a thumb rule, something which is expensive 50% above their fair value zone at such high valuations should be a red flag to you, even if the
Hmm.
earning growth traction remains very high. Because the day earnings start decelerating a bit, or maybe the incremental ROIC started decelerating a bit, you will see a very sharp correction in those stocks. Just imagine if that day you're not ready to act, you are on holiday or vacation, or you are doing something else and still be part of your thesis is no, it's a long term story. What will you do? So first step is don't make those mistakes. If you are in those things, so try and avoid, have little position, have lower position sizing there. Do periodic checks. That's why ongoing monitoring of funds and portfolio is also an important factor of the investment framework.
Okay. So I'll just take one question from the thing as we there's a question from again Srinivasan. Also approach towards that tactical bet for 1-2% each company, or can we allocate more, say even 5% to a single stock as well if I have more conviction on that particular stock? I think it's more towards a personal thing.
See,
Person
I
liking
think,
stock
yeah,
actually.
I think it's a very personal approach to investing. If you ask me as practitioners, I follow very simple decision metrics where you say position sizing has to be proportionate to your conviction level. So you rank 10 stocks you have conviction level of 100%, 80%, 50%, 30%. 30% idea has to be a weight corresponding to 30% conviction. It cannot have a 5% weight, it has to be a lower weight. But let's say if it's a high 80% conviction stock, no point having a 1% weight over there or a 30 pips weight over there. So I would say link it to your conviction level, and the cumulatively all the stocks. How it's not that all of your portfolio will be made of such stocks, right? Cumulatively, how many stocks like this are you owning? Are there 15 stocks like this? Like I went to an investor meeting some days back, and there was a very successful guy who probably just normal chit chat on market. I like 50 companies, all of them are trading at fairly good valuations, which is fine, which is okay. But will you buy 50 stock portfolio at one go, 1% to each of it? It's like spray and pray. Then it start becoming index, you fall prey to the entire market thing with some bit of an alpha. So I would say do not spread very high, don't over diversify.
Okay. Not too much of concentration and not too much of diversification.
Absolutely, yeah.
Got it. Let me take, I think we've already touched the timeline of it. I'll just take one more minute. Because we are in the correction phase now, because the markets are in the correction phase, the one behavioral, part of investor is fear. Either it's fear of investing or fear of being invested. So, these other two fears are running into the market now. Are they genuine? And how should an investor look into this, fear for now?
See, we have seen this phases in the past. In the last 20 years, you and I both must have seen at least 4 to 5 such cycles. So in times like these, as practitioner, I also ask myself just three questions. So first question is it a sentiment correction? Which probably is the answer right now, because sentiments give you either numerical ways to measure it. How many stocks are down from 52-week high? What is the trajectory of that fall? What is the general sense in the market right now? Second question is it a valuation correction? For example, whether things were trading very expensive and now they are just correcting. And third question is whether it's a fundamental correction, whether the fundamental thesis is going wrong, India's growth rate is going to collapse or businesses are going to get hit. Probably not. So, if the answer is just first value sentiment correction, don't get bogged down. Sentiment will change because sentiment are supposed to change, right? You cannot have a single sentiment for a long period of time. Secondly, valuation correction, if that happens, that is healthy. because it's
Hmm.
giving you an opportunity to buy at a lower prices at a fair valuation level. And third, which is if there's fundamental correction, then you should be worried and take appropriate steps. Currently, I think it's just about sentiments, maybe a little bit about valuation, but fundamentally, I think everything looks quite good to me from a bottom up perspective. So we're quite bullish on the market from that view.
Okay. Thank you, sir. Thank you. That was a lot to take home today, and bring it a long week off, and still people have joined us. And I need to thank both of you, like of course the speaker as well the audience. I think there are a few more questions which was not taken, during this live. Probably that can be given to you. I would request you to to answer them and send it back to the respective people. And before we could sign up, I think I need to thank both of you and have a great weekend.
Thank you so much and wish you all the best. Thank
Yeah,
you.
thank you.